If you give a data scientist 100 historical data points, they might use, well, maybe 10 or 15 variables to build a predictive model.
Right, yeah. You wouldn't want to use more than that.
Exactly. Because if they decided to use, say, 150 variables, they would literally be laughed out of the room for overfitting. I mean, conventional wisdom says you simply cannot have more variables than you have observations.
Oh, absolutely. It is arguably the most fiercely guarded rule in statistics. You pare things down, you isolate the signal, because if you overload a model with more dimensions than you have data to support, the math just, well, it collapses under the weight of its own noise.
Which makes today's deep dive so incredibly compelling. We are exploring a 2026 finance paper, and it's titled Complex Modern Portfolio Theory. It's by Helm, Jensen, Kelly, and Malamud. And these researchers discovered that in the high-stakes environment of statistical modeling, that laughable overfitted model might actually be the only one that works.
Yeah, it's quite a paradigm shift.
It really is. Our mission today is to unpack how they proved that intentionally overwhelming a system with variables, I mean, literally pushing past the breaking point of traditional math, is actually the secret to radical performance.
It completely dismantles decades of financial dogma. But to really appreciate the mechanics of how throwing more complexity at a problem actually solves it, we have to establish the baseline they're breaking.
Right, we need to know what the rules are before we break them.
Exactly. So we have to look at Harry Markowitz's 1952 Modern Portfolio Theory, or MPT. Markowitz formalized how an investor should theoretically combine risky assets. And the whole setup assumes, three fundamental things.
Okay, lay them out for us.
You need to know the assets available, their expected average returns, and their covariance.
And just a quick refresher for you listening, covariance being the measure of how these assets move in relation to one another. Like if tech stocks drop, do utility stocks rise? You map all those interlocking relationships to really understand your overall exposure.
Right, precisely. And from those inputs, Markowitz defined two primary optimization goals. The first is the mean variance efficient portfolio, which most people just call the classic Markowitz portfolio.
The one everyone chases.
Yeah, its objective is to maximize your return for every single unit of risk you take on. But the second is the minimum variance portfolio, or MVP.
So if the Markowitz portfolio is trying to, strike a perfect balance, the MVP is really for the purely risk-averse.
Very much so.
It basically abandons the pursuit of high returns altogether and strictly looks for the mathematical combination of assets that offers the absolute lowest volatility.
On paper, both of these are just elegant, beautiful solutions. But when practitioners took MPT out of the laboratory and actually applied it to real markets, it was, well, widely considered a catastrophic failure.
A total disaster in the wild.
Yeah. And the underlying reason for that failure comes down to a metric the paper defines as statistical complexity. They denote it by the letter C. And complexity is simply the ratio of your assets, which we call N, divided by your time observations, which is T.
Okay, let's unpack this. Because understanding this ratio is kind of the linchpin of the whole paper.
It really is.
So if you are analyzing, say, 50 stocks over 100 months of data, your C's ratio is 50 over 100, so that's 0.5.
Correct.
And the Markowitz math was originally designed for a world where C is effectively zero, like a handful of assets backed by just an infinite ocean of historical data.
Under those very specific conditions, the law of large numbers reigns supreme. Your estimates for returns and covariance, they're stable. But the moment C starts creeping up, as the number of assets begins to even rival the number of historical data points, the covariance matrix becomes violently unstable.
And that's because estimating the covariance between every single pair of assets requires just a massive amount of cross-referencing, right?
Exactly.
If you have 50 assets, you aren't just making 50 estimates, you're calculating over 1,000 interacting relationships. And without decades of history, a few random outlier months will completely skew the correlation data.
That's the danger of noise.
Right, so the mathematical optimizer sees a phantom pattern, which is pure estimation noise, and it basically bets the farm on it.
It does. And the authors highlight a really brutal example of this from a 1999 paper by Britton Jones. So picture this. An investor tries to allocate wealth across just 11 country indices using 120 months of data.
Okay, so an N of 11 and a T of 120. That is a complexity ratio of 0.09. That barely registers on the complexity scale.
Barely a blip. But even at 0.09, Britton Jones found that the model's recommendation for how much wealth to put into the U.S. equity index had a standard error of 47%.
47%.
Yes, the optimizer is practically guessing at that point.
Oh, wow.
The historical data just isn't deep enough to smooth out the anomalies of those 11 interacting markets.
I mean, a 47% margin of error means the model is functionally useless.
Com-
And this is why the financial industry famously abandoned MPT in favor of the 1 over n portfolio. And for you listening, the 1 over n portfolio is just pure, naive equal weighting. You take your capital, you divide it evenly among all available assets, and you do zero mathematical optimization.
Not at all.
It's almost embarrassing, really, for the quantitative finance industry that for decades, a strategy requiring literally zero math consistently beat Markowitz's Nobel-winning formula. And it did that simply because it bypassed estimation noise entirely.
It's the ultimate workaround. And so the consensus became this ironclad law. As n gets closer to t, as your C ratio approaches 1 MPT crater.
It just hits a wall.
Yeah, the noise completely corrupts the covariance matrix. The Sharpe ratio, which, measures the return you actually capture for the risk you endure, it drops to near zero. Concurrently, the MVP's actual real-world volatility just explodes.
I love to think about it like predicting baseball. It's like trying to perfectly predict the outcome of an entire baseball season by only watching 3 random innings of play. The noise of those 3 innings overwhelms your model. So just guessing all teams are equal actually performs better.
That is a perfect analogy, yeah.
But if a complexity ratio of 0.9 shatters the model, standard logic dictates that pushing the ratio to 1.5 or 2.0 would produce absolute mathematical garbage.
You would think so, yeah.
But I'm guessing this dead zone is exactly where the authors found their anomaly.
Oh, they blew right past it. They intentionally constructed environments where n was strictly greater than t, so more variables than observations. And the paper reveals what they call the double ascent curve.
Double ascent, okay.
Right. So as complexity moves from 0 to 1, performance dives into a crater, exactly as history warned us it would. But as C crosses 1 and hits 2, 3, and 4, the curve radically reverses.
It goes back up.
It rockets up. The out-of-sample Sharpe ratio of the Markowitz portfolio climbs to new heights, and the out-of-sample volatility of the minimum variance portfolio plummets. In high complexity, more assets are a blessing, not a curse.
Here's where it gets really interesting. Because the linear algebra governing this should not allow that to happen.
Mathematically speaking, it's a huge problem.
Right. The Markowitz formula explicitly requires calculating the inverse of the covariance matrix. But if you have more columns of variables than you have rows of historical data, that matrix is singular.
Yep.
And traditional mathematics says a singular matrix cannot be inverted. It is literally an impossible calculation. So how is this even working?
Well, that mathematical impossibility is actually the catalyst for the entire phenomenon. Because you cannot use a standard inverse when n is greater than t. The researchers employed a generalized tool called the Moore-Penrose pseudo-inverse.
A pseudo-inverse. So instead of a standard calculation, it's forcing a solution.
Essentially, yes. It is finding a solution in a space where infinite solutions theoretically exist. Because there are more variables than constraints, the math has room to maneuver. The pseudo-inverse naturally selects the solution with the smallest overall norm.
Okay, and what does that mean in plain English?
It means it inherently avoids extreme weights. This applies a phenomenon known as implicit regularization or ridge shrinkage.
Implicit regularization. So the math is effectively buffering itself.
Precisely.
By forcing the model to distribute its weights more evenly across a massive number of assets, it prevents the optimizer from placing concentrated catastrophic bets on a few noisy signals.
Right, but it actually goes beyond just buffering. In high-dimensional spaces, a crowd wisdom effect takes over.
A crowd wisdom effect.
Yeah, it's akin to guessing the weight of a cow at a county fair.
Oh, I know this one.
Right, so if you ask 3 people, their individual biases and wild miscalculations, that's the noise, might skew the average severely.
Yeah, one person guesses 10 pounds, the other guesses 10,000.
Exactly. But if you ask 10,000 people, the sheer volume of data forces the individual bad guesses to mathematically cancel each other out, leaving you with a highly accurate true signal.
That makes total sense.
Yeah.
The errors offset. One asset's overestimation of risk is just neutralized by another asset's underestimation.
Bingo.
And in the classical regime, below a complexity of 1, you just don't have enough assets for that crowd wisdom to activate. Every new variable just adds unchecked estimation risk.
You're just adding noise.
But once you cross into high complexity, the implicit regularization kicks in. The noise, literally cannibalizes itself.
The structural risk stops growing quadratically and stabilizes into a controlled, linear state. The model survives the noise by absorbing it.
Which is just a brilliant mathematical parlor trick.
Yeah.
But practically speaking, we still have two distinct portfolios competing here. We have Markowitz chasing optimal returns and the MVP hiding from risk.
Yes, the classic showdown.
So when you drop both of them into this high-complexity, heavily regularized universe, who actually capitalizes on it better?
Well, the paper runs extensive high-complexity experiments. For instance, they use a short rolling window of just 12 months of data to allocate wealth across 153 U.S. factor portfolios.
That's a lot of factors for just 12 months.
It is, and in these short window environments, the minimum variance portfolio thoroughly outperforms the Markowitz portfolio. It achieves a significantly higher Sharpe ratio.
Wait, really? The portfolio designed specifically to ignore returns actually generates a better return-to-risk ratio than the portfolio engineered to maximize it.
It does, and what's fascinating here is why the MVP dominates. Both portfolios utilize the exact same heavily regularized covariance matrix to assess risk. The divergence lies in how they handle expected returns.
Okay, how so?
The Markowitz portfolio actively tries to use the noisy sample means from that short 12-month window to chase performance.
Oh, I see. It looks at a factor that surged over the last year and assumes, well, it's just going to keep surging. It loads up on an asset based on a fleeting trend.
Right. And in high dimensions, those sample means are notoriously unreliable. The Markowitz model ends up basically weaponizing noise.
Ouch.
But the MVP succeeds because its core mandate completely ignores mean estimates. The researchers refer to this as dogmatic shrinkage.
Dogmatic shrinkage.
Yeah. By focusing solely on variance, the MVP mathematically shrinks all expected returns to a single fixed constant. It treats every asset as having the exact same forward-looking return.
So it acknowledges that the short-term return data is just too polluted to trust, so it levels the playing field entirely.
Yeah, exactly.
By throwing out the bad information, it allows the implicit regularization of the covariance matrix to do all the heavy lifting without any interference.
That's exactly right. But this raises an important question. Is dogmatic shrinkage always the superior strategy?
I'm guessing no.
You'd be right. The MVP's dominance relies on the assumption that the mean estimates are hopelessly noisy. The researchers demonstrated that if you stretch the training window pushing T's from 12 months up to 36 months or more, while still maintaining high complexity, the Markowitz portfolio eventually overtakes the MVP.
Because with 3 years of data, the historical averages finally graduate from pure noise to actionable signal.
Yes.
Once the expected returns become reliable, the MVP's strategy of blindly ignoring them turns into a liability. You just start leaving money on the table.
Precisely. With sufficient time depth, Markowitz can finally execute its dual mandate. But, and this is cool, the authors didn't stop at observing the natural, implicit regularization of the pseudo-inverse.
But they pushed it further.
They tested what would happen if they actively reinforced the model. They introduced explicit constraints, like a mathematical ridge penalty denoted as z equals 10 to the negative third power, which deliberately smooths the covariance matrix even further.
Oh, interesting. And didn't they also test a no-shorting constraint?
They did.
Basically removing the optimizer's ability to borrow assets to bet against them, which historically is where models take on their absolute most toxic risks.
Yes, exactly. And when they layered these explicit guardrails onto the high-complexity models, the out-of-sample performance just soared. The combination of high complexity and slight explicit shrinkage definitively crushed the 1/n equal weight baseline that had embarrassed MPT for decades.
That is wild.
Yeah.
So the underlying Nobel theory was sound all along. It just required an overwhelming amount of variables to execute properly.
That's the irony of it.
But wait, if dogmatic shrinkage and implicit regularization work so perfectly on cleanly synthesized factor portfolios, the obvious trap is assuming this survives contact with raw, chaotic, individual stock data.
Right, because stocks are messy.
Yeah, stocks aren't neat. The company's behavior fundamentally changes over time.
They address that too. The paper runs the exact same methodology on individual stock data from the Center for Research and Security Prices, and the distinction between factors and raw stocks becomes really stark here.
How so?
When forced to use a tight 12-month training window, the naive 1/n portfolio actually puts up a fierce fight against individual stocks. The noise is simply too dense.
So simplicity wins there.
Temporarily. But when they expand the estimation window to 60 months, while still maintaining an N much larger than 10, the high-complexity MVP once again eclipses the 1/n benchmark out of sample.
Okay, but what about the Markowitz portfolio? Doesn't it mount the same comeback here with 60 months of data?
Surprisingly, no. Markowitz struggles deeply with raw equities because individual stock returns are highly non-stationary.
Meaning they change too much.
Right. A 5-year historical average of a tech company's explosive growth is rarely an accurate predictor of its returns next month. The economic reality of the asset has fundamentally shifted.
So because Markowitz relies on those past averages, it continually builds models for a market that literally no longer exists.
Exactly. The MVP, utilizing its dogmatic shrinkage, inherently sidesteps that non-stationarity problem. It only cares about how the assets correlate, which is a far more stable metric over time.
So the MVP proves to be the ultimate survivor in real-world conditions.
It does.
But the paper pushes this beyond just building portfolios of stocks, right? They apply this high-complexity theory to macro-risk hedging.
Oh, this is one of my favorite parts.
Yeah, so for you listening, suppose an institution wants to immunize itself against a shock in crude oil prices, or a sudden spike in the VIX volatility index, or even shifts in the 10-year to 1-year Treasury term spread.
Hedging is fundamentally an exercise in correlation mapping. You are trying to construct a sub-portfolio of assets that reliably mirrors the target risk, allowing you to offset your exposure.
And the standard instinct would be to carefully curate, maybe 10 or 20 assets intimately tied to the energy sector to hedge against crude oil. You keep the variable count low to ensure you actually understand the mechanism of the hedge.
Right, you want it to make logical sense to a human.
Exactly. But the data reveals the exact opposite. When attempting to hedge macro risks, throwing significantly more assets into the hedging portfolio drastically increases its out-of-sample correlation to the target.
Yeah, a portfolio utilizing 150 seemingly random, dense factors to hedge crude oil significantly outperformed the carefully curated, low-variable portfolio.
Which is mind-blowing.
It is. The exact same virtue of complexity emerges.
Because the sheer density of a 150 asset network can capture incredibly nuanced, hidden time series patterns that a human analyst would never spot in a million years.
We just can't process it.
Right. The implicit regularization filters out the noise of the unrelated factors, leaving this highly sensitive synthetic mirror of crude oil's market behavior.
And just to confirm that this phenomenon isn't just a quirk of monthly market cycles, the researchers stress-tested the math using high-frequency daily data.
Oh, really? Daily data?
Yeah, they ran the high-complexity optimization using just 21, 42, and 63 days of daily return observations.
Wait, so flooding a model with over 100 assets based on just a single month of daily trading behavior?
Exactly. And it still worked.
No way.
The high-dimensional models produce highly attractive out-of-sample returns that easily surpassed the 1 over n benchmark.
That's incredible.
It solidified that the virtue of complexity is a fundamental structural law of high-dimensional math. It's completely independent of the data frequency.
So what does this all mean for you listening? If you are analyzing a data set, or engineering a predictive model, or evaluating risk in a complex system, your training likely screams at you to trim the fat.
It does. Less is more, right?
Right. You pare down to the essential variables because you want to avoid overfitting. You want a clean, legible equation. But this deep dive illustrates that the pursuit of simplicity often leaves you vulnerable to the noise of a small sample.
Very vulnerable.
Sometimes the solution isn't to retreat from the noise. It is to aggressively push straight through it. By crossing the threshold into high complexity, adding a massive volume of variables, you trigger a mathematical threshold where the system begins to implicitly regulate itself.
The math heals itself.
Exactly. The errors offset, the noise cancels out, and the true signal finally emerges.
You know, if we connect this to the bigger picture, the mechanics of implicit regularization might actually offer a fascinating lens into human cognition.
Ooh, I like where this is going.
Well, think about it. We know that mathematical models fail spectacularly when their variables perfectly match their data constraints when c equals 1.
Right, that's the creator of the double ascent curve, the absolute zone of maximum estimation error.
Exactly. Now think about human decision-making. When you face a difficult choice and you only have a handful of distinct data points, say a short pros and cons list, what do?
You agonize over it.
Right, you overthink. The noise of those few variables paralyzes you and your decision-making craters. That is human cognition operating at a complexity ratio of 1.
Oh, wow.
But consider how your intuition functions. When you enter a room and instantly read the dynamic between two people, your brain is processing thousands of real-time variables.
Like micro-expressions, posture,
Vocal cadence, historical context, all of it.
You are absorbing massively more variables than you have the conscious time to process. So your internal cease ratio is off the charts.
Exactly. Because your brain cannot explicitly calculate the math on thousands of variables, it bypasses the conscious optimization entirely. It relies on its own biological pseudo-inverse.
Oh, that is brilliant.
It aggregates the massive network of signals, allows the contradictory noise to cancel itself out, bounds the extreme inputs, and hands you a remarkably accurate gut feeling.
We always assume logic requires simplification.
But perhaps the virtue of complexity proves that true precision only exists on the other side of chaos.